welcome to this session about capital requirements and sovereign wealth funds. My name is Nassos Manginas, and I am your host. We will have a series of short presentations in order to allow yourselves and ourselves to talk about this very interesting topic. And some important points before we start. Please switch off your mobile phones. If you want to meet us, please do this at the end of the session, because there's going to be another one starting here at 11 o'clock. And if you're interested in the slides, you can leave your cards, or they will be emailed to you directly from ReadMeDem. Without further ado, I would like to introduce the speakers and the panel. To my left, we've got Paul Clark, Director of Investment and Asset Management at the Crowne Estate. In the middle, we've got Richard Yorke, who is Managing Director at EMEA at Real Capital Analytics. And to the far left, we've got Mr. Fadi Moussalli, who is Regional Director at the International Capital Group of Jones Lang LaSalle. And he's based in Dubai. I would like to ask the fellow panelists to shortly introduce themselves before we start with the discussion. Paul?
Hello. Good. Working. Paul Clark. I'm the Director of Investment and Asset Management at the Crowne Estate. We're a UK-focused real estate business. Principally, we concentrate on the West End of London and prime retail outside of London, but we also have significant interests in UK agricultural land and also alternative energy offshore.
Hello. Hello there. My name is Richard Yorke from Real Capital Analytics. We are a global consultancy, and our specialism is tracking capital flows into real estate. We've tracked approximately 250,000 individual deals over the last 3 years, totaling around $3 trillion worth of investment. Many of those investors are sovereign wealth funds and pension funds, and so we spend time tracking the origin of those funds, the kind of investments they're making, and who they're making them with. So hopefully today's presentation is quite relevant.
Hello, my name is Fadi Moussalli. I'm based in Dubai and cover the Middle East for Jones Lang LaSalle. My specialty is to create relationship with those sovereign wealth funds and those institutions that would like to invest across their border. So investors from Dubai or Abu Dhabi or Saudi Arabia wanting to invest in Paris, London. My job is to know them, create relationship with them, and to put Jones Lang LaSalle products and services to them. That's it.
Right. Just a few slides about IPD. This is obviously not about us today. We are at the center of the real estate market regarding the fact that we have, I think, a unique position regarding the performance measurement and benchmarking and all analytics, including risk services of the real estate market. Where you are different from other market players is that we do not provide consultancy services nor advice. So the information that we have comes directly from the real estate portfolios of the various institutions that participate in our data banks. Essentially, what we do is we've been active since 1985 in 25 odd markets. And we do produce indices. These are the small numbers on the top of the slide that I will not ask you to read at this point. We cover some 700 billion euros on the pan-European scale as of 31st of December last year. And this goes up to $1.1 trillion if you include also the other main investment markets, which are Canada, US, and Australasia. Essentially, what we do is we aim to provide dedicated real estate analytics and benchmarking services for a variety of real estate investors. And what this slide tries to show is effectively the fact that we aim to be able to approach questions for listed and unlisted vehicles, direct and indirect property, and debt. Simply because the real estate market becomes more mature and more transparent, and also given the fact that the economic conditions of the last 2 years have been quite volatile, we do believe that, generally speaking, the allocations to real estate are going to be further on the increase. And last but not least, we seem to think that we cover a very good percentage of the actual and potential market share of the main players internationally. We have got the top 10 or top 9 from the global real estate or fund managers, and we do believe that with the growing importance of real estate, we will be able to represent a far growing share of the international real estate market. Thank you.
Okay, so this session is about sovereign wealth funds. The least I could say is that analysts and firms and research people do not agree on the definition of the sovereign wealth funds. So I took as a sample 2 definitions here. I'll give you 10 seconds if you want to go through them, what I notice is that there isn't any research analyst who would define sovereign wealth fund in the same way. So here I got 2, the IMF working group that tried to do a definition. I don't like it necessarily. And then we have Investopedia, and there are many others. Basically, why do people do not agree on the definition of sovereign wealth funds? The reality is there are many types. So according to what type you are focusing on, then you would attribute a certain definition. And those types, I will put them in this slide here. I tried to subdivide the various sovereign wealth funds in 4 categories. And I know what I'm saying here might be a little bit controversial, which I'm happy with, and I'm happy to discuss that with you. But that is at least my understanding of sovereign wealth funds and their various categories, which I classified according to investment behavior, really, and essentially investment agenda. So I put 4 categories: the generation funds, which is really the history of sovereign wealth funds, and I'll get back to it. Then the opportunistic funds, which are usually more recently created. They all date from the 90s, or the year 2000. Then strategic fund, also quite a recent invention. And then I put the last category, which is really, they are real estate developers, but they are very much walking and talking and applying a sovereign wealth fund agenda. So if we go back to the generation fund, that's the history. This is where it all started, at least in the Middle East. And again, I'm specialized in the Middle East, so I will not comment on non-Middle Eastern sovereign wealth funds. In the Middle East, I would say Kuwait Investment Authority is the oldest. It has been established in the 50s, so very old. Then Abu Dhabi Investment Authority, everybody knows ADIA. ADIA was established in the 70s. And then the other 2 that are more recent. These funds have been established as a political decision, and the whole purpose was to safeguard the wealth, today's wealth, for future generation. One day, if oil dries up, or one day, if there is a new substitute to oil, then at least the future generation of those countries will benefit from the wealth that their ancestor did. That is the whole idea. That is the philosophy. And this is, I would say, when someone talks about sovereign wealth funds, then they designate what I call the generation fund. Then we have the opportunistic fund, Qatar Holding, Istithmar. I have listed a little bit. You know, again, new creation derived from their fathers on the top. And those opportunistic funds, like their name indicates, they are there to grab opportunities. Strong firepower, strong cash, no need for a leverage. the dream buyer for any seller. With this said, they like deals at very, at very good prices. So not really the dream buyer, but at least the cash is there, the firepower is there, and the quickness in taking a decision in there, unlike the ones on the top. Strategic funds, I put Mubtalakat, Investment Corporation of Dubai, Emirates Investment Authority, Mubadala. I would say these are funds that consolidate local assets and consolidate local cash flow from government-owned assets. And often this cash flow is very much positive. So with that surplus of cash flow, what do? You want to diversify overseas. And this is why those funds have the tendency in looking outside their own countries to buy stuff. I call them strategic fund. You might agree or not agree. Government-backed real estate developers, again, let's take the most high-profile one, Qatari Diyar. We all heard that Qatari Diyar, who is a local real estate developer, went and bought a big piece of land in London called Chelsea Barracks for more than £1 billion in 2007, and they are developing it. Nakhil, again, went outside their home country, which is Dubai, and so did Amar and Barwa. So just to come back to the objectives, again, I have put all the objectives in one basket here, and each one of these objectives could or could not fit the various categories that I gave. Protect and stabilize the budget and economy from excess volatility. That's one strategic objective. If oil price goes down, then there is enough cash to cater for the bad days. So that is one of the objectives. Diversify into non-renewable commodity export. Sorry, diversify from non-renewable, again, diversification play. Earn greater return than the plain vanilla deposit. Assist monetary authority to dissipate unwanted liquidity. Again, the economies of those countries very often is too small to be able to swallow all the surpluses, and hence the need for the outside diversification. Political strategy, again, we all know, for instance, that Qatar these days is very much buying political goodwill across the world, not only in Europe, but in the US, in Latin America, in Asia. This is a country that is emerging and is creating friends across the world and political ties and diplomatical ties. This is why you hear a lot of the Qataris buying in foreign markets and sometimes in very remote markets. Sustainable long-term capital growth. I mean, there are many objectives. I have put a selection of some of them. Just to close with that chapter, I took a selection of real estate deals, high-profile real estate deals that were done, recently. Maybe the one you all heard of is Harrods. That was bought by Qatar Holding last year. The price is estimated at 2.2, but the reality is that there wasn't any official price, so we put an estimation. Then again, the Qataris bought the US Embassy in London. It's still the US Embassy in London, but the objective is to convert it into a hotel when they vacate and go to their new premises. There is another one that I like, which has been done by the Omanis. Oman is an investment fund. In 2009, out in 2010. They made, they got the timing right, and they made big profits. And I'm happy to say that in most of these transactions, Jones Lang LaSalle had a role to play. And this is exactly the job that I do. I sit in the Middle East. I try to talk to these funds, and I try to get them to work with Jones Lang LaSalle. That's it. I put in the last slides how to go ahead. Will the sovereign wealth fund apply a more domestic agenda? Will they be more transparent? I know this is a very big issue that sovereign wealth fund are criticized about, being more transparent, disclosing their agenda, and being arm's length with the strategic interest of the country they represent. That's a very big issue. There was a conference in Santiago in Chile, and there was the principle derived from that conference about 3 or 4 years ago towards more transparency, towards more disclosure, and towards more fair competition. SWFs and the current political situation in the Arab world. That's an interesting topic to discuss. You know, how will these sovereign funds, how this government money will react now that there is a lot of political turbulences in the Middle East. And the biggest example is the Libyan Investment Authority. We all know and heard that the assets were freezed. So freezing the assets of a sovereign wealth fund or a government, that is creating a precedent. How to deal with that, and what does freezing mean, and how to unfreeze it once the situation is restored. This is an interesting question. And then how to approach them. I would say I'm based in Dubai, and I'm very happy to discuss any approach of any of you. Thank you.
Okay, thanks very much. I've only got about 3 slides, so I'll be fairly quick. Just a recap, Real Capital Analytics, our raison d'etre is tracking capital flows into real estate. And as I say, we've tracked about $3 trillion or so dollars worth of deals over the last 3 to 4 years. Many of those deals have been deals undertaken by sovereign wealth funds or national pension funds. This is our definition of the top 20 sovereign wealth funds active over the last few years. Our definition may well be different to my colleagues' definitions or all definitions. This is something we're always keen to get into and discuss. But in total, we've tracked around 17 billion euros worth of transactions undertaken by sovereign wealth funds over the last 3 to 4 years since 2008. And the slide here shows the top 20 investors in descending order. And hopefully you can read that slide. Hopefully it's not too busy. But you can see who the largest investors have been, headed by the Canadians, followed by the Singapore, Korea, Dubai, and so on and so forth. Very exotic list of organizations, not simply from the Middle East, where I think most people tend to initially think about when they think about sovereign wealth funds, but clearly you can see the geographic spread of funds, be it Canada and North America, be it Norway, be it Asia, and so on and so forth. So this is the amount of money that's going into real estate, and you can see it's a significant amount of money, particularly when you consider the economic and real estate backdrop to these numbers over this period. So these are significant players, and their significance is being felt more and more keenly, particularly in the large capital markets that many of you are obviously involved with. It's unsurprising to see that the most popular markets for sovereign wealth funds have been those large, glamorous megacities, topped by New York, topped by London by quite a big margin. But also you can see other big Western destinations, be it Paris, be it Berlin, be it Rome. And for many of these sovereign wealth funds, these transactions in places like Paris, in Rome, and London are some of the first transactions they've made outside of their domestic country. So these are significant new players for many people in these markets. But as you can see from the list, these investors aren't simply investing in the large established Western markets. We're seeing increasing flows going into emerging markets and new markets. So we're seeing cities like Rio, Taipei, Seoul, Singapore, Australia, so on and so forth, also benefiting from these very considerable capital flows. And then my final slide just gives some examples of some of the deals that we're seeing involving sovereign wealth funds. The first one, the Bishop Square deal, that's an example of actually a sovereign wealth fund actually selling an asset. So they're not just simply buying assets, but they're selling assets as well. The next deal, the GIC deal, again, this is an interesting deal because it's an example of a joint venture. Sovereign wealth funds do use joint ventures in other vehicles in order to establish themselves in new markets, obviously to benefit from the experience and skills of their JV partners. I think that's a continuing trend. The Regent Street deal, the acquisition by the Norwegian pension fund, which I'm sure Paul can tell us much more about if he so wishes, is an interesting deal in the case that this is, I think, the Norwegians' first major foray into real estate for them.
And last but not least, the South, keep saying North Korean. The South Korean pension funds acquisition of the Sony Center in Berlin a few years ago. I think that was their first significant acquisition outside their home region. So I think these transactions just give a flavor of the diversity of deals we're seeing. Clearly, there tend to be very large deals in established locations with good income and all the rest. But as we can see, it's not simply a buy situation. We're seeing sell situations, we're seeing JVs, and we're seeing real estate as a first foray for these ventures. Okay, that's my slides. I'll go and sit down.
Thank you very much to both of you. Let's start the panel session by first realizing that there doesn't seem to be a standard definition of sovereign wealth funds, and also the fact that these happen to be large players, primarily driven from local governments, is something that I think we do not need to preoccupy ourselves at this panel. It was also quite interesting to see in Richard's slides that you can actually mix the more typical sovereign wealth funds with very large pension funds, whether they are CalPERS or others, simply because they seem to follow pretty much the same type of strategies. And it was also fascinating to hear from Fadi the political and economic situation which has been governing these sovereign wealth funds from their inception, actually to today, with all the recent economic and political upheaval, say in the North African region. But this is a session about primarily trying to look and understand how these funds operate into the real estate sector. So I would like to start by asking Paul whether he believes that the sovereign wealth funds in their investment strategies are having certain characteristics that distinguish them from other real estate players in the market.
Okay, well, I suppose I ought to start my answer by saying that most of our experience with sovereign wealth funds is with those organizations that come out of more mature Western-style democracies, so that's North America, Europe, and one or two other jurisdictions around the world. And even that group is not particularly homogenous, but what I think does mark them out is they've often got relatively small teams with a global mandate. They're not about wealth preservation. They actually are seeking identifiable investment returns, and they go about their due diligence in a way that most investment fund managers would recognize, and they're very thorough and professional in what they do. And certainly what most of them are looking for is that they're going to concentrate a lot on the major prime global markets, but they will also, depending on their geography, be prepared to invest in emerging markets, as you've seen from the presentations. And probably the North Americans are more inclined towards South America, and other jurisdictions perhaps might look at Asia more. But they, in terms of where they invest and who they invest with, they do like partnerships quite often, and they're looking for stability not only in the economy that they're investing in, but also in the corporate structure of their partners. They like a long-term outlook, and they like their partners to have a long-term outlook. They do sell from time to time, but most of them have got such significant volumes of cash coming in that they are much more likely to be placers of capital than looking to extract profits, at least in the short to medium term. And it's also important with these organizations that when they're dealing with other parties, that their standards of governance and transparency are of a very high standard and equal to their own. And most of these organizations do have a very high level of transparency. And importantly, they also like to see with their partners and the people they're dealing with experience in their chosen sector, and a strong track record, and a team that's got a track record of delivering. So I suppose that's quite a long-winded answer to your question, so sorry about that. But they do have those sort of characteristics in common, and I think we will see them in the larger prime markets, and then in some of the emerging markets around the globe, depending on the jurisdictions they're operating from.
Thank you. Fadi, you seem to be primarily specialized, as you said, in the Middle Eastern region. Given the fact that the sovereign wealth funds emanating from this region have been traditionally managing and or investing surplus capital and foreign exchange reserves, would you say that their allocation to real estate is a relatively recent phenomenon? By that I mean, do you have any numbers or any evidence that primarily they've been investing in other assets or undertaking financial transactions, and real estate has been relatively recent? And if you were to to put it on a scale from 0 to 100, I don't know, you might get to 5 or 7 or 10% maximum?
Yeah, I would say, I mean, with the Santiago principles that I just mentioned during my presentation, there is a push towards more transparency and more disclosures. If you go into websites recently, you would observe, for instance, on ADIA website, which is really maybe the mother of all sovereign wealth funds, given its size and profile, you would see that they have they just disclose in percentage term their allocation to various asset class. And if I remember well, that was something around 15%. That is the official stance. With the other sovereign wealth fund, it's very hard to tell because, again, transparency is still in its infancy. But I would say, to answer your question, and given I'm an Arab and I know the mentality, real estate is an asset class that Middle Easterns have a lot of affinities with, okay? People like real estate, people like to look at it, to touch it, to walk by it and say, it belongs to me, you know? So I would say real estate occupies a very significant portion of the asset allocation across. And it all usually starts by real estate. You know, there's the cash, and then the next thing we do is buy a building or invest in a fund and start to generate income. So I would say real estate is very, very important in terms of an asset class. And of course, they do buy into equities, bonds, hedge funds, private equity, etc. They do have diversified guidelines and envelope, but real estate is always there. It's usually is the major asset class in terms of weight in the overall portfolio.
Thank you. Following on from that, this question is for Richard. You did put this, your last two slides, and actually making the point that in the recent transactions over the last couple of years, you had sovereign wealth funds being on the buy and also on the sell side. Would you be able to comment whether they seem primarily to have been on the buying side, and how does this tie in with their rather possibly longer investment horizons, and try to compare this to other real estate players?
Sure. The vast majority of the transactions we track are on the buy side. We do see some sales, but that tends to be the exception rather than the rule. And so the vast majority of those, I think, the 17 billion euros worth of deals over the last 3 or 4 years, 99% of them, or maybe that's a slight exaggeration, but certainly a very, very high percentage are on the buy side. And as I said, those tend to be, I guess, unsurprisingly, large, chunky assets in very good locations, tend to be very, very good tenants, generating fantastic income streams. And I guess that very much ties into the long-term investment horizon these types of organizations have, which are going to be 10, 20 years or more, potentially. So that they can afford to take a very long view about their investments and take a long view about how that investment might look in 5 or 10 years' time, given changes in the world. So these tend to be, from our experience, long-term investments. Again, Paul can reflect on the deals that he's been involved with. And certainly the kind of deals we've seen, for example, the Sony Center deal in Berlin, that was a €1 billion deal. It was a pretty skinny yield on that. 4% or whatever, maybe even a bit less than that. So for some investors, that's not enough. But obviously for the Korean pension fund, they thought that was good value, and obviously taking a long-term view. And I'm sure that's reflected in other deals that we're seeing.
Yes, thank you. So we seem to have established that the sovereign wealth funds are effectively more on the buying side. They do occasionally sell, but they seem to be long-term investors. So for this type of investor, a buy and hold strategy seems to be working pretty well. Paul, if you look at the sovereign funds and real estate in particular, would you be able to tell us what type of real estate is it that they like? Do they have a particular preference for either, I don't know, big chunky trophy assets that this has been commented on? But I'm trying to get here a bit more into their sector allocation within real estate.
Well, in terms of the size of deals that these guys like to do, to some extent it's needs must, and they are looking for quite significant lot sizes. That's because most of them have very significant sums of money coming through the door, which they need to place. That also means there is more stress on the buying than the selling side. In prime markets, I think you will find that they will tend to look most closely at office and retail, particularly offices, because you've quite often got the best data set for that sector. Some of them are involved in residential, but I would say that commercial is by far the most significant asset class, because you see them in the big prime urban centres. You see them less in distribution and in industrial, but perhaps also in some of the emerging markets you will see them doing more residential, particularly sort of mid-range residential development. They do take on a bit of development as well, but they're not a homogenous group either. There are some who are much more comfortable with development because that's what they're used to in their home market than others. But I would say mostly they're looking for standing investments that they can see long-term outperformance from, and they are prepared to look through any short-term market turbulence in order to see what the returns will be over 5, 10, 20 years and more.
Okay. Fadi, would you happen to know whether when the sovereign funds invest, whether they do have a kind of structured investment decision framework? And when they invest, do they have also the more known notion of risk-return preferences that you might find in other types of real estate players?
Yeah, that's a good question. I think that, again, I'm talking about the sovereign wealth funds in the Middle East. The oldest ones, the ones created in the 50s and 60s and 70s, tend to behave like an institution with various layers, with an investment committee and a chairman of that committee. Then if a deal is killed, then you can appeal and it goes again to another committee. So it really works a little bit like a big bank that takes lending decisions. I refer here to maybe Abu Dhabi Investment Authority, who is the most institutionalized fund amongst those funds. The real estate department, for instance, there is more than 100 people. So you imagine you need to manage those people, and everyone in these 100 people has a role to play and something to say. So yes, there are the big ones work like an institution. Then the more recent creations tend to be more, I would say, more formal in terms of investment decision process. Less formal, There is very often one or two guys who take the decision, which is usually the most senior person there. And sometimes, again, I want to be politically correct, some decisions that are taken escapes the logic that you thought you knew about them. So there is some kind of volatility in investment decisions in the more recent and smaller funds, and there is more stability and consistency in the more larger and older funds, if I answer your question.
Yes, absolutely. Thank you. Richard, when you put your slide about their favorite locations, cities, I seem to remember that, and you have said this as well, it was the large metropolitan regions or cities, I don't know, New York, London, Shanghai, Tokyo, and so on. Given the fact that there are long-term investors possibly requiring a rate of return that is sufficient for them, but might not satisfy other real estate players, do you believe that they will keep investing or buying primarily into these core locations and, of course, this exerting a clear impact on pricing in these locations? Or will they also diversify out into what we currently know as developing world? So what is their strategy looking forward?
Well, I think looking at the survey evidence, and obviously these sovereign wealth funds tend to be fairly opaque, so trying to get decent information on them can be quite difficult. I think on average, their allocation to real estate is around 7%. Clearly, you're going to see some variation around that. And again, I think some of the stats I've seen suggest that they're, on average, going to allocate something like 8-9% on average. And given they've got something like 4 trillion of assets under management, that's going to equate to quite a large chunk of change. So I would suggest that they're clearly going to continue to look for investment opportunities, particularly in those large markets. Obviously, acquiring the standing assets may be easier said than done, given maybe the lack of availability. I think we'll probably see more sovereign wealth funds committing investment to development, to creating new fantastic schemes because of the lack of available, ready-made available opportunities. I think that's going to be the case. But certainly the places such as London, places such as New York, those big established centres will continue to see a lot of investment activity from these types of organisations. And clearly that's going to have an impact on other players in the market who could well be priced out. These guys can use debt, but clearly they're bringing a lot of equity to play, which can sort of crowd out other investors. But I dare say they will also be frustrated by the lack of opportunity, and will no doubt will look at other markets. And we're seeing obviously some sizable investments in places like Singapore and Sao Paulo and other locations. And there's a mixture of investments, as Paul said, sort of mid-high level residential and retail and office. So I think we'll see more investment coming into the big established centres. I think we'll see more development being driven by these funds, but also I think that we'll see them going to new emerging locations. And maybe we'll have to redefine those places. They won't be emerging. They'll be quite established pretty soon. Just walking around Hong Kong or Singapore, looking at the skyline, they seem very established. So I think so the pattern we've seen, I'm sure, is the pattern we'll see going forward.
Mm-hmm. Would you like to comment on that, Paul?
I think we need to remember that we're not dealing with a homogenous group, and consequently they're not all market makers. And certainly in London, there is a difference, I think, between those funds that concentrate on wealth preservation and those that have a more investment management, fund management approach to future returns. And it's the former, I think, that tend to get most of the headlines. And they're the ones that the press like to comment when they strike a deal, and they often are deals which are struck at pricing which a lot of other investors won't be able to compete with. But there are also plenty of sovereign wealth funds who are running pretty standard due diligence activity. Their cash flows look much like any fund manager, and they're expecting prime returns, so they're not going in for sort of geared 20% plus returns, and that consequently their return horizons probably are lower than opportunistic for. They will be lower than opportunistic funds or core plus funds. They'll also be lower than a lot of REITs, so that does make them competitive in the prime locations. Consequently, I think you will see their activity focused on those areas, and their appetite for markets outside of the prime global centres. I think you would include places like Hong Kong and Singapore in that. Often depend on their home jurisdiction, and for example, it does make North American funds more comfortable with South America and Brazil in particular, and perhaps makes Australasian funds more comfortable with Southeast Asia.
Yes, absolutely. Would you be able to comment, that's also for you, Paul, on what seems to be their favorite way of entering real estate? Do they prefer a direct route? Do they go the JV route? Or do they invest indirect?
I think for the big ones, funds are pretty much out now. Those that have been involved with them have not had great experiences during the downturn, and their preferred route is going to be either direct or through joint ventures. When they're entering a market for the first time, it's more likely to be through joint ventures. Most of them, as I said, have relatively small teams with big global mandates placing a lot of money. So unless they're buying a fairly dry investment, they are going to look for a local partner. The local partner will need to have the sort of characteristics that they value in terms of stability and a long-term approach and high standards of corporate governance and transparency. And they will look to approach those joint ventures generally in the most tax-efficient way that they can. But equally, they're not going to have to be highly geared particularly or too esoteric in the way that they're structured.
Fadi, you touched in your last slide about the very, very important issue on transparency. And obviously here, we at IPD, we do work with sovereign wealth funds as well, and we do promote transparency. Would you happen to have a kind of magic formula of how one approaches sovereign wealth funds? What is the best way to approach them, and what is the best way to introduce them to this world of greater transparency, the benefits of sharing information, etc.?
Yeah, I would say, you know, like in any process, I would say the sovereign wealth fund, initially when they were born in the 70s, the generation fund, you know, they applied a very simple mandate, and transparency issues were not an issue in the 70s and 80s. Now it's becoming more of an issue, and as a response to that, they gathered as an association and they said, okay, let's go sit down and talk, and let's see how we're gonna be more transparent. At least it's a start. And out of this discussion came out some principles that are called Santiago Principle that are really militate towards more transparency. Now, transparency is relative. If you take funds like the Norwegian Sovereign Wealth Fund, with whom Paul Clark's company has done a big deal recently, I mean, transparency is a concept in Western Europe, and the same word means something different in the Middle East or in Asia or in other parts of the world. So I would say everything is relative. There is a move towards more transparency. There is a realization by sovereign wealth fund in the Middle East that they just cannot continue to not be accountable for what they do. And as such, if you know, people who have followed ADIA would have seen the changes in their website. Before, the website of ADIA was 2 pages, and as of 4 or 5 months ago, it's now maybe 10 pages. So there is clearly a move towards more transparency. But let's not forget, at the end of the day, that you know, it's as if you are asking you know, a foreign minister to tell you to disclose his strategy on things that they consider to be a secret. I mean, sovereign wealth fund is very much ministry of finances in those countries in a way. You know, you cannot ask a minister to be to have audited accounts and to tell you what they want to do and to disclose each and every penny. It doesn't work this way. So, you know, according to cultures, according to country, the transparency notion has different meanings across the world, I would say. And we are moving towards the right direction, I would say, but it's a long way towards full transparency.
Yes, absolutely. And given the fact that there are cultural differences and different notions of the same concept, one has to look at it more in terms of a process, as you rightly say, rather than something which will happen, I don't know, tomorrow or at the end of the year. We have come now to the 15-minute or so mark, and this will give you, ladies and gentlemen, the possibility to ask questions to the panel and to us. So please feel free to ask the question and also say the company that you're coming from.
Richard, what do you see in terms of dollars over the next, thank you. It's John Celestri from GlobeStreet.com. What do you see, Richard, in terms of, dollar amounts? You gave a listing before of what has been for the next year or so. Could you give a rough ballpark total?
I'll say we don't actually produce forecasts of investments, so we're only tracking sort of historic trends. So I don't have any ready-made numbers in my head, unfortunately. Clearly, we've seen a significant increase. So the 17 billion I mentioned. I think we'll see increases going forward, maybe of a similar magnitude. Clearly, the world is ever-changing, and I guess there are kind of upsides and downsides to that number. Maybe that Fadi at Jones Lang has got
Yeah, I was about to say, again, in the Middle East, my answer is specific to the Middle East. When we said the local domestic agenda, during the crisis, it is a fact that Middle Eastern economies have suffered starting, after Lehman, especially after Lehman.
We all did.
Yeah, but just taking the Middle East an example. So they have clearly suffered, and everybody knows that in the Middle East, the cash allocation of sovereign wealth fund has decreased because the money, the surpluses, if any, were directed towards pumping much-needed equity in various infrastructure projects, in various domestic companies, domestic developers, domestic utilities that needed the cash to fulfill their local agenda. And therefore, the ability of sovereign wealth fund to export capital has reduced significantly during the second half, starting the second half of 2008, up till, I would say, now, these days, we are kind of seeing a recovery. That is the general pattern that I have observed, and that the statistic that we do ourselves demonstrate. The latest trend is, yes, indeed, we are seeing more appetite, especially now that oil is trading above $100. Every day that oil trades $100, the coffers of those sovereign wealth funds get refurbished. And therefore, we are observing now with the recovery, the global recovery, a tendency of a higher cash allocation to sovereign wealth fund, which in turn will invest more in real estate and other asset classes. Does that answer your question?
Yes, as close as you can. Thank you.
Thanks.
Any other questions?
Inna Zhuranskaya from Deutsche Bank. I would like to ask, in your opinion, is there any appetite among sovereign wealth funds in emerging Europe? By emerging Europe, I'm referring to Central and Eastern Europe, Russia, sort of further afield. You mentioned Latin America, you've mentioned Asia. Obviously, GIC went to Russia and kind of stopped there. What about other funds, especially Arab funds?
Yeah, like the statistic you just showed, there are, again, for the Middle East, traditional destination. London has always grabbed the lion's share. I would say if I had to rank them, by order of preference, it can be London on the very top, and then you have maybe equal seconds is Paris, New York, Washington, something like that. And then if you go down, you would see maybe Germany, Australia, main cities in Australia. And then if you go further down, you start seeing the Central and Eastern Europe. So Central and Eastern Europe, unfortunately, is not on the top of my investors' agenda. But it's a matter of culture and history and affinities with certain regions. However, we are not immune from, as a diversification play, seeing big transactions made by sovereign wealth fund in the Middle East in those countries. And the reality is that at Jones Lang LaSalle, we have transactions in those countries that I managed to create some traction around, in Poland, in Croatia, in Montenegro, in places that are not really on the top of the list. But it's more the exception rather than the rule.
If I can also comment on that, there is an interesting situation here. I think we seem to have established that, let's say by Western type standards, in inverted commas, sovereign wealth funds, for various reasons, are not that transparent. On the other hand, they do undertake significant steps to transparency, but they do like to invest in very transparent markets. By that I mean that the whole Central and Eastern European region, and also if you take it further east to Russia, is a market or a region, a geographic region, that has become more and more transparent. And if one also thinks that, by and large, sovereign wealth funds seem to invest as a combination of a macro play, which is, the economic region, but also an asset-specific play. So if you look at any of the transacted deals, and you could kind of metaphorically move them to, to Warsaw or Budapest, then there is a very, very clear indication that this might happen. And on the other hand, if you believe that property markets internationally are getting more and more like they possibly used to be pre-Lehman crisis, so multipliers start to harden, there isn't any, at least economic reason, to suggest why sovereign wealth funds should not be investing in Central and Eastern Europe if the deal is right and the property is right.
I would like to add one comment, is that during the heydays up till 2007, when yield compressed a lot in the Western world, then spontaneously we saw a kind of shift towards more juicy markets. So it was an alternative. It is, okay, London is too expensive. Okay, what do we do? What can we do in Eastern Europe? But it's not, we want Eastern Europe. You see what I mean? It comes as an alternative or as a solution to a certain problem. With this said, and again, it's so hard to put clear investment patterns. We are not immune from seeing a big splashy transaction in Eastern Europe from one of these sovereign wealth funds.
Any other questions? Please, the gentleman first.
Hello, Stuart Law from Assets in the UK. We're master developers of a resort scheme in the Cape Verde Islands. Wondered about the appetite of sovereign wealth funds for these types of emerging markets in the hotel resort sector.
Who likes to answer this?
In the what sector? I did not hear properly, sorry. In the?
Hotels.
Hotels.
Resort hotels. Yeah, either residential mixed with hotels or just the hotels. Five-star.
I mean, in Adia, for instance, there is a very big hotel department. And in the list that I mentioned, indeed, we have seen companies like Categorizing buy into resorts as far as Cuba and Seychelles. So the answer is yes, but of course the devil is in the details. The other thing is hotels as an asset class makes some people dream, Hotel embeds values of prestige, of trophy, of pride, etc. And therefore, sometimes you would see a sovereign wealth fund applying the agenda of the big boss there who likes hotels. Because he either has a souvenir, a memory in this hotel when he was a child, he used to go there when he was, and then it doesn't take more than that to, when the Crillon Hotel in Paris is for sale, then it attracts interest from sovereign wealth fund very naturally, because Crillon is Crillon, it's Place de la Concorde, it is the trophy, and therefore, I would say the answer is yes. Every sovereign wealth fund looked at the Starwood Capital portfolio that was for sale in Paris. All of them looked at it. I mean, they ended up not buying it, but they all looked at it, which means, yes, there is an interest.
Okay, thank you.
I think it's much less likely to be the case with the sovereign wealth funds coming out of the more mature Western democracies, where decision-making is on a more corporate and more transparent level. If they invest in that sector, and some of them do, they're more likely to be in their home markets than overseas, and they're more likely to invest in a chain of hotels in a portfolio, and the management alongside that as well, rather than to go for one of the big high-status hotels in one of the major centres.
The gentleman here, another question.
Peter Note, Scottish Enterprise. Paul mentioned the affinity for Western sovereign wealth funds to enter into JVs. I just wondered if Fadi could to speak about the appetite for joint ventures for Middle East sovereign wealth funds, and what sort of partners they generally tend to want to get into bed with.
You mean what's the appetite in Germany?
No, the appetite for JVs in the Middle East.
For JVs, I would say whatever you said about the way they like to enter the market, that's true. It's either I buy a direct income-generating asset, easy to manage, low risk, low return, long-term, stable, predictable income, and that I don't need a JV partner for. I hardly need an asset manager, or I can asset manage it myself at home. The other way is definitely it is JVs, and we have seen a lot of JVs where the equity is teaming up with the expertise on the ground. They do realize that you cannot pretend to be an expert in all jurisdiction, and very often the fees that you pay to your partner as a manager, as an asset manager, are very much justified. So very often you would see 75, 80, 90% equity partner silent, sovereign wealth fund, and then you would see a 5 to 25% active managing partner, which is the JV partner. That's very much a scheme that especially the Omanis are familiar with. I mean, this Bishop Square transaction you mentioned that we worked on was like that, and there are plenty of other examples. I would say Abu Dhabi Investment Council that bought into the Chrysler Tower in 2008. They had, I think, 75% of the equity, and Tishman Speyer kept 25% of the equity. Tishman is there managing, and the equity was brought by Abu Dhabi Investment Council, which is very much a sister fund to Abu Dhabi Investment Authority, but with a different, I would say, agenda.
Any other questions? I do see that we have a minute or so to end. Gentleman standing.
My name is Marcel Meijs from the Netherlands. It is announced that you will tell something about Sharia investments. Can you tell something specific about Sharia, and what is the limitation of that?
Yeah. Just for the sake of everybody, Sharia investment is investment that are complying with the Muslim guidelines, and the main one is you cannot lend money and earn interest rate on the money lent. So yes, I mean, a lot of the sovereign wealth fund that I listed, very ironically, are not Sharia compliant. In the 50s and 60s and 70s, finance, technology, credit derivative did not allow people to go for Sharia compliant deals. The trend now with new funds is indeed towards complying more with Sharia. And therefore, some funds will not be able to buy the Goldman Sachs headquarter in London because there is Goldman Sachs in it, and Goldman Sachs is a conventional bank that very much makes its money on the principle of interest. But the big ones, the old ones, are not Sharia compliant. They are conventional funds, and therefore any asset class is eligible. Now, you don't have to push it too far in terms of going against the principle, but a headquarter of a bank is definitely eligible for a fund like Abu Dhabi Investment Authority or Qatar Holding, etc. Not all the sovereign wealth funds of the Middle East are Sharia compliant. In fact, a minority of them is Sharia compliant.
Thank you. I think we have come to the end of the session. In trying to conclude with one sentence, I believe that we have learned that sovereign wealth funds have been an important player. They will continue to become an important player in international real estate markets, and possibly their allocation to real estate is on the increase. For me, I would like to thank you for your attention and also thank my panelists for a very, very interesting session. Thank you very much.